What's up everyone? Welcome to Personal Finance with Humphrey. If you don't know who I am, I'm Humphrey and I'm passionate about teaching you personal finance. So subscribe to my channel and hit the notification bell because I post a video pretty much every week. So today we're talking about compound interest and how you can actually use compound interest to turn $1,000 into $10,000. Now, I know that sounds a little bit like a clickbait title, but it's not. And this entire strategy takes a lot of time. So the younger that you start, the better. And you'll understand when I go into it a little bit more in depth, but basically this is just math, guys. Like it works. You just have to trust in it and believe in it as long as you have the patience and the discipline to stick to it. So let's talk about compound interest and let's get right into it. Again, I want to reiterate that this is not a get-rich-quick scheme. There are a lot of people on the internet these days trying to get younger people, impressionable investors, to start day trading or playing options or sharing information about a certain stock pick that they really believe in. And a lot of young people are flocking to it, and you can kind of see that just in how the market has been super swingy lately. A lot of people see an opportunity to get into the market, but really they don't really know what they're doing. There are a lot of people that want to sell you a course or sell you information about how you can get rich quicker, but honestly, those strategies are always going to come with a ton of risk. So yes, while 1 out of 1,000 people might turn $1,000 into $10,000 overnight, the 999 of them probably have lost all their money. If you really want to turn $1,000 to $10,000 without absolutely doing anything, you can use something called compound interest. With compound interest, you're taking an initial investment, let's call it $1,000 in this case, since that's the example that we're using, but you're using $1,000 as your principal, which is your starting balance. And as long as you're getting a rate of return such as 8%, which is, by the way, the average annual return of the S&P 500 for the past 50 years has been 8%. So how do you actually get 8%? Well, what you can do is actually buy something called an index fund that tracks the market. So an S&P 500 index fund is just a collection of all the S&P 500 stocks in one investment vehicle. Anyway, it's been returning about 8% for the past 50 years. So if you had your principal balance of $1,000 and you were getting 8% a year, you'd get a certain thing called interest, which is $80 in this case. 8% times 1,000 is $80 a year. So if you were to invest your $1,000 in an S&P 500 index fund or any type of investment that returns an 8% return, and you kept all of your interest earnings in that same account, so you never took out any money, but you just kept earning 8% a year over year over year over year, that's called making money on your money or interest on your interest, and that's the beauty of compound interest. By the way, I did make a video on how to invest your first $1,000 if you'd like to check that out. I'm gonna pop it up somewhere here, like up there or up there. I think that based on the camera angle, I think it comes up at here. So if you want to check out that video, please do. So back to compound interest, I want to show you guys what the time value of money is and how that compound interest is going to compound over the period of 30 years, where you literally have to do nothing and you can get from $1,000 balance to $10,000 balance. Basically, you 10x your money in 30 years, but the whole point of this strategy is that you need to allow time to work its magic on your balance. I'm going to pull up a graphic right now, but I'm just looking at it on my computer. But in year one, you can see that you have $1,000 initial investment at an 8% interest rate. You're going to earn $80 on your interest. So at the end of the year, you're going to have $1,080. Now in the next year, year two, that same thing's going to happen, but this time 8% of your initial investment now is 8% of 1,080 instead of 8% of 1,000. So now all of a sudden your interest earned for year two is $86. And then your total earned after year two is $1,111.66. I said that kind of weird, but $1,166 is now your balance at the end of year two. And you can see where I'm going with this. Every single year that you do this, your balance at the end of the year gets bigger, and then that 8% times that balance that you have at the beginning of the year is going to be even more interest, and it's just going to keep compounding and compounding like a really big snowball. So just like a snowball, it's going to start off basically like a snowflake, and as you go down the hill, it's going to get bigger and bigger and bigger until it has so much momentum that the growth is going to be exponential. And let me show you guys what that exponential growth looks like right here. So scrolling all the way down, if we just look at say like year 29, our beginning balance in year 29 is $8,627. 8% on that 8627 is now $690 in interest earned in year 29, which, if you think about it, in year 1, we were earning $80 of interest for that amount of time. In year 29, we're earning $690 for that same amount of time. So literally the same time frame, we're almost earning 9x what we were earning in year 1. However, you have to understand that this took us 29 years to get to. But as you can see, when we hit year 30, your ending balance is actually going to be over $10,000. So this is pretty cool. It's $1,000 invested at something at 8%, and all you did was just sit around on your hands. You didn't do anything, and all of a sudden you made $9,000 extra dollars, and now you have a total balance of $10,000. So when I say you can turn $1,000 into $10,000, this is exactly how you would do it. The other thing that you can do is continue to additionally fund your balance size. So what a lot of people do with their investment strategy is they'll take $1,000 and put it in an investment account. And after you have that $1,000 in that investment account, they're going to continually add additional funds and deposits to that investment account to continue to grow their money. Instead of taking 30 years to build up $10,000, you can really take $1,000 and grow it even faster if you continually add to that initial balance size. So real quick, let's look at a scenario that'll show the real power of compounding. In this scenario, investor A starts saving at the age of 25, saves $2,000 a year, and assumes an 8% interest rate. Investor B enjoys his or her life until the age of 35 and then starts to save that same amount and then invest at that same interest rate. We can see the results here. Investor A starts off at the age of 25, but by the time they're 65, their actual account balance is going to be $603,000 because they started 10 years earlier. Investor B, on the other hand, because they started at age 35, they lost out on 10 years of time. And time is the most important part of a compound interest calculation. So because they missed 10 years at the beginning, Investor B now only has $264,818 at the end of 30 years of investing. And as you can see, at age 65, Investor A actually made $338,000 more than Investor B just by starting 10 years earlier. I just want to point out in this scenario, both investors are adding $2,000 a year to their portfolio. So if you're 20 years old and you're looking at this, now is the right time to start investing and to start investing for the long term and to stay disciplined, because by the time you're 65, you'll be probably easily a millionaire, if not many times over. If you're 35 or 40 or 45 or even older, it's never too late to start saving and investing for the future. You might just have to up your contributions if you can with, hopefully increased income. But it's never too late, and as you can see, even if you are Investor B, you're still making a decent amount of money by the time you're 65 or 70 or 75 or whatever time you're ending your compound interest strategy in. If you ever want to figure out how long it'll take for your money to double, there's something called the Rule of 72. I think it was coined by Albert Einstein. That's what a lot of articles are saying online, but nobody really knows for sure. The Rule of 72 says this: if you take the number 72 and you divide the interest rate that you're targeting, that'll tell you the number of years your investment will take to double. I'm pulling up this chart right here, but basically if your interest rate was 6%, you can see here that it would take your investment 12 years to double. And if you're getting a 20% interest rate, it's just gonna be super fast. But again, guys, the main thing here is that you're consistent and you're disciplined and you're sticking with this strategy for the long term. One quick note about staying disciplined is time in the market beats timing the market. So right now the market is swinging like crazy, as I said earlier, and a lot of people are going to feel pressured to take out their money or take out their investments from their investment account, or maybe they see a dip and they want to buy a bunch of investments. In any case, time in the market is going to be timing the market. So if you're a beginner investor, just remember that as long as you're in the market, you're doing something right, as long as your time horizon is long enough to justify being in the market. The more time you give your investments, the more you're able to accelerate the income potential of that initial investment, which takes a bunch of pressure off of you. Personally, I've succumbed to peer pressure before of people saying that you should take your money out when things weren't going so well. About 7 years ago, I was persuaded to take some money out of the market just because I thought that the market was going to crash, and that ended up being a huge mistake. I lost out on 2 years of returns because I just kind of sat around in cash waiting for a while. But as you may know, we had a bull run for quite a long time from the periods of 2010 to 2020. Ever since that, I've been trying to just stick to my own investment strategy and not try to let other people tell me what to do. Since I'm investing for the long term, I really want to just take advantage of the compound interest strategy I'm laying it out here. Now let me tell you about how compound interest affects my spending and how I think about spending money. If I don't really need something, I'm not gonna buy it. I've thought about this for a really long time before. Like, there are things that I really want, but sometimes I just don't need them. If you really, really need something, there's no problem with buying something. Like, if you need a new chair, go buy a new chair, especially if it's ergonomic. But if you want something, let's say you want a new gaming PC. This actually happened to me last week. One of my friends works for a gaming consulting business, and one of the gaming companies was going out of business, so they were selling a lot of I say old, they're actually brand new computers, but they were selling at a discounted rate, and he offered me one for $1,250 when the retail price of these computers was like $2,000, 2.5 grand. And I thought about it for a long time, and I really wanted one of these PCs, but I don't need a new gaming PC. My gaming PC is only 4 years old. It runs perfectly fine. It plays all the games I want it to play and more, and there's nothing wrong with it. So I didn't need this new gaming PC, so I just didn't buy it. I mulled over that decision for quite a long time because it was such a good deal. But in the end, I just thought, you know, I'd rather have the $1,250 because $1,250, believe it or not, is gonna be worth so much more with this strategy. So like, let's say instead of spending that $1,250 on that gaming PC, I'm putting it in the market and I'm just letting it kind of just sit there. Well, in 30 years, based on what I've showed you here, that's gonna be worth like $12,500. Guys, I hope that you enjoyed this video today and that you learned how to use compound interest in your own investment portfolio. If you would like to learn more about investing, you can join my free Discord, which I'll put in the description below. I have a community there. I think we have 100 or 110 people in there so far, and we talk about things like e-commerce, entrepreneurship, investing, stocks, personal finance, and all that stuff. And it's completely free. You can reach me there at any time. So the link will be in the description below. And as usual, please subscribe and like to this video. I know I already said it in the beginning, but every new subscriber helps me do this on a more full-time basis. I would love for this to be my job and to educate you guys on financial literacy and any other topics that you want to hear about in terms of personal finance. If you want to see me do like cool challenges too, or you know, when I hit 20,000 subscribers, I was thinking about eating like 20 donut holes or something like that. Please subscribe. Thank you for being here. I really appreciate all you guys. And please leave me comments because I will respond to them. And I love hearing from you guys. So thank you. See you later.